All right, so should I buy the dip in stocks? Like, should I buy a stock when they're near their 1-year low? Well, check this out. Morgan Stanley analyzed about 6,500 publicly traded stocks from 1985 to 2024. And the research and data shows us that the steeper a decline is, the less likely the stock is going to fully recover. Also, the data shows us that the median sell-off from top to bottom, meaning the highest price they ever were, to the very low, the valley, well, that was about 85% over a 2.5-year period. That's the median sell-off. That's pretty drastic between you and me. So when we take a closer look at Exhibit 4, the base rates for drawdown, duration, and recoveries by max drawdown. Stocks that go on a sell-off and drop by more than 95%, this first row right here, well, they only have a 16% chance that they'll ever bounce back to their price prior to the decline. So if they were like $100 a share and then they went on a sell-off of like 99%, the statistics and data show us that only 16% will make it back to their original price of $100. And from their study, about 1,800 companies fell into this category. And what's crazy is if a stock experiences a drawdown of about 55%, so this row right here, well then the chances of a recovery are 77%. Now I don't know about you, but I like those odds. 3 out of every 4 companies that drop by more than 50 to 55% over a period of 1.4 years, 77% will recover and bounce back. So why is it that some companies, when they go on their sell-off, they're able to bounce back, whereas others, they just go bankrupt or get delisted or they're forever crushed in their stock price valuation? Well, that's because not all companies are created the same. Some companies, they're absolutely crappy, with shaky financials, poor management, and a business model that's just irrelevant in 2025 or 2026. Like a physical printing newspaper company going into the 2000s. Their business model, absolutely doomed. So their sell-off was probably justified. But when we think about the other companies, the high-quality dividend compounders with strong balance sheets, predictable cash flow, and a history, timeline, and DNA of navigating tough cycles where they weather the storm time and time again. Those type of companies that I just described, they will eventually bounce back. The statistical odds are 77%. And when they do bounce back from their 1-year low, their annual return is absolutely bonkers. Because if we turn our attention to Exhibit 5, the base rates of returns by magnitude of maximum drawdown from 1985 to 2024, if a stock goes down by about 98%, and looking on the bright side of things, they're a part of the 16% that eventually recovers, then their 10-year CAGR, year over year, the compound annual growth rate, taking into account the share price appreciation plus the dividends paid out, is 32.6% when we take into account the 16% that do bounce back. Their 1-year return when the recovery happens, 297%. But between you and me, those odds are, those are a little, that's into that gambling and betting, casino slot machine territory. A 16% success rate, I don't know about that. However, if we scroll on down and consider the companies that drop by 50 to 55%, because remember, that success rate is 3 out of 4 companies will bounce back. Then, when they recover, we're looking at a 19.6% CAGR year over year for 10 years. And in that first year, when they have that initial surge and bounce back, 65%. Now, between you and me, yes, the gold is much richer when you buy into a stock that dips 98, 99, or even 100% for that 300% potential return in the first year, but 16% is the probability, and that's just too low for my risk tolerance. But when we're talking about a high-quality dividend compounder that dips by 51 or 52%, and the odds are 3 out of 4 bouncing back, I like those odds. So thinking about the companies that do defy the odds and recover from their sell-off, the probability of a true rebound goes up significantly if we know, I'm repeating myself here, but if the company has pricing power, meaning they are a monopoly or they're operating in a duopoly or an oligopoly, well, there's no real competition. So they determine how much they want to sell their products for. Macro environment conditions have no or little impact on their pricing model. Or if the company in question is profitable and they're cash flow positive, even during the downturns, you can take a look at their financial statements for the past 10, 15, 20 years to see how do they perform when everybody else is suffering. So if the company in question is profitable, that increases the likelihood as well. And then another factor is if it maintains or grows its dividend through the chaos. And that's why when I look at companies like PepsiCo, who have been paying and growing their dividend for the past 50, 60 years, dude, you love to see it. They have weathered the storm in the 1980s, 1990s, the 2000s, and everything else in between. PepsiCo, high quality. And if the company in question has low debt and an economic moat, dude, sign me up. And then, of course, most importantly, if the company is going on a sell-off because it's temporarily hated because of some bad press, and it's not permanently broken, like their business model still prints cash, their balance sheet is still flush, and their market position and competitive advantages tells me that it's a high quality company, then yeah, they're going to rebound. Now, what I just said is not biblical truth. It's not going to be 100% success rate, but if they meet all of those criteria that we just covered, they're going to be okay, and they're probably going to be a part of the 3 out of 4 that bounce back if they dip by 51 or 54%. And I'm sure every single one of you watching this video, you probably had a company in mind as soon as I started reading off the criteria. Recent examples include Meta, Google, Microsoft, anybody on the Mag 7 or S&P 500, whenever they went on a 1-year steep decline, if they are high quality, then they bounced back. And that's why between you and me, I think it's so freaking important to look at the fundamentals and numbers to see if the company in question has a chance of survival or not. If you only look at their stock chart, I'm not trying to be the bad guy here, but you're basically gambling. But if you look at their fundamentals and you can forecast their revenue models, their free cash flow, and you discount their dividend to see how their growth is going to be healthy and juicy in the future, I think the probability is better and in your favor. So when you're thinking about buying the dip, don't just look at how far the price has fallen. Just because the price goes from $100 a share down to $23, it does not mean that it's on discount and it's time to scoop up the shares. You really want to ask yourself the fundamental question, is this a great business on sale? And in the words of Warren Buffett, I want to buy companies that are on the operating table because they're being sold off left and right, and everybody, including your ex-wife, is just hating on them. That's exactly when he wants to buy into them. But if that is a great company and they're just going through a temporary storm for the next 3 or even 9 months, that might be the time to buy it up. But of course, you also want to be smart about this because is it a great company on sale? Or is it a terrible, ugly, and a hot mess that's finally priced correctly? Sometimes a company goes from $100 down to $24 because they are inherently crappy. And everybody was piling their money into them because of speculative, narrative, or story-driven reasons. Because when you pull open the engine of the car and you take a look at the transmission and the engine and everything else in between, it's unprofitable. They're shaky financials. They don't even pay a dividend. They have a crap ton of debt, and everything is just ugly. So when you have a junk car like that, a lemon, and they're going through a storm, dude, they're not going to be able to weather it. Time and time again, I've personally seen stocks get delisted because they file for bankruptcy. So, if it's a good company, a high-quality dividend compounder that goes on to decline, even though their financials and fundamentals are still practically sound, I think the odds are in my favor if I pick those ones and I buy into them, banking that they're going to rebound. And I thought this was a pretty interesting call out from the study. So when we think about Nvidia, one of the best pound for pound performers in the S&P 500, their compound annual growth rate, also known as the CAGR, is 39% annually. When you look at their peak price in 2002, well, they actually exhibited a pretty deep decline and they dropped by 90% all the way to the bottom right here from January of 2002 to October of 2002. So in about 10 months, their decline day after day, week after week, it just went on a sell-off. And it took them about 4.1 years to recover. So October 2002 to November of 2006, 4 years and 1 month for them to be at the exact same price that they were prior to the decline. So as you can see, even in the company history of Nvidia, one of the best performing stocks that we know today, it took them 4 years to recover from their dip. So please do not think that buying on the dip is an overnight or next week rebound kind of a thing or ordeal. It takes time. Now, in my next upload, I'm going to be showing you some real examples of when I bought the dip, at least in the past 5 years. And we'll break down what has worked, what did not work, like when I lost the money, and then the lessons that I learned. So if that interests you, you might as well subscribe. I'll talk to you guys next time. Stay safe. Good luck in the stock market. I love y'all. Peace.